Hi, this is Raman, your tutor from Alberta Real Estate School. In today's video, we will take a look at net present value. Net present value is a concept from commercial real estate course. So net present value is used to figure out if the investor will make a return on their investment and actually if they'll be able to meet the type of return that they're looking for. So let's take a look.
In this video, we'll take a look at how to calculate the net present value of a project. So net present value is a way that we use to determine the current value of all future cash flows that are generated by a project. So for example, if somebody were to buy a commercial building, in that case, we would have a yearly cash flow. So basically, we will have the net operating income that would come in from the building. And we will take a look at how much that money that is coming in over the years will be worth in today's dollars. And the reason we need to do this is so that we can see if the project is going to be profitable or not. Or we can also use it to compare many different projects and see which project will be profitable or which project will give us the highest rate of return. So let's take a look at an example. So let's say Tammy is a real estate professional who's representing a client interested in purchasing a commercial building. Tammy believes that she can negotiate a price of $1.6 million, and the client wants to sell the property after 4 years for $2 million and wants to earn an annual return of 12%. So Tammy projects the net operating income to be $300,000 for the first year, $315,000 for the second year, $325,000 for the third year, and $345,000 for the fourth year. So in this case, what is the net present value for the investment? And we have 4 options here. So let's take a look at how we would approach this project. So first is we need to figure out the different cash flow. So in this case, we will use our HP 10B2 financial calculator. So in this case, our first cash flow is $1.6 million. And this has to be negative because this is the money that we are putting out. This is cash outlay. So cash outlay would be negative and cash coming in will be positive. And then a second money or income that we are getting in the first year in that case. So initial investment is 1.6 million. In the first year, we get $300,000 in net operating income, then 315, 325. And in the fourth year, we have to account for the income that is coming plus the money that we receive from selling the building. So in this case, it would be $345,000 plus $2 million. So $2,345,000 will be our cash flow for. And the rate of return that the investor is looking for here is a 12% rate of return. So that will be our interest rate. And then we will look at our net present value. So in this case, the answer is $640,591.69, which was our last option here. All right, so let's take a look at the actual calculations. Okay, the first step here that we would need to do would be, first of all, clear the calculator. So we always clear the calculator first. In this case, our first cash flow is 1.6 million. So we will put in 1.6 million here. And this would have to be negative. So we hit the minus key here to make it negative. So that's our first cash flow, and we will store it in CF0. The net operating income for the first year is 300,000. That will be a positive cash flow. So we would store that in CF1. 315,000 is our second cash flow. And then 325,000 is the third cash flow. And then we have 345,000 plus 2 million would be our next cash flow, and that gets stored in CF4. Our rate of return here is 12%. So we store that in the interest, and then we will hit our orange shift key and click on the net present value button. So as we can see, Our net present value here is 640,591.69. Therefore, 640,591.69 would be our net present value for this project. So in this case, the net present value is positive, which means the investor will get higher than their required rate of return, which means instead of earning a 12% return, they will get higher than 12% return. So if the net present value is higher than zero, that means they will get a higher rate of return than their required rate of return, in this case, 12%. If the net present value is negative, it doesn't mean that the project will lose money. It just means that the investor will not get their required rate of return. So they won't make 12% on their investment. But in this case, it's positive, which means they will make a higher rate of return than what they're expecting of 12%. So that's it for today. I hope you enjoyed this video. If you would like to get some help with your commercial real estate licensing exams, I invite you to visit our website, www.albertarealestateschool.com, or you can give us a call at 587-936-7779. There are many ways we can help you pass the exam. You can do tutoring with us, whether that is on an hourly basis or for the entire course, or you can buy study guides from us, which includes the summarized version of the notes as well as practice questions. That's it for today. I will see you next time.